Morning and welcome to the Wednesday morning roundtable for February 2022. We're delighted that you're able to join us online. For safety's sake, we have decided to go remote in February, and we'll be assessing this as we go through every month for the coming months. But this is the first in a series of programs from the Wednesday morning roundtable looking at the impact of COVID on a number of fronts, including the economy, workforce development, as well as healthcare. And at the end of May, we will do our Veteran Services program that we have planned out. But today we want to look at the economy and deal with it, not necessarily from a COVID perspective, but also looking at the short-term outlook of the economy and the markets. We're in an odd time. Like the 1970s and 80s, we have high inflation. But we also have the opposite of low unemployment, and we'll talk a little bit about that. So while the media might be talking about spikes in inflation, we want to look at both the macro issues with Peter Kneis of M&T Bank, and we're going to look at the markets with Tamer Elshourbagy from Tompkins Trust, I should say Tompkins Financial Advisors, who advises the college on a number of fronts, and we appreciate his work. But we're looking at the economy as a whole. As I mentioned, Mr. Kneis is with us. He has come to us by way of Meg O'Connell, one of our members of our steering committee. He recently presented to Center State CEO, and he is the Group Vice President of Commercial Planning and Analytics at M&T Bank. He's been a bank veteran for 20 years and specializes in, and this is my favorite position, balance sheet forecasting and customer profitability. You may have to explain that on a national, state, and regional level. He analyzes economic data to cater forecasts to the industries and regions that he covers. And previously, he worked for business unit CFO, covering commercial and support units to the bank. When he's not at work, he is watching his daughter play volleyball and his son play hockey and baseball. So he's a summer sports guy. So he's going to look at the larger macro issues, and then we'll turn to Tamer to talk more about the markets. So Mr. Kneis, welcome.
Thank you. Good morning, everybody, or thanks for the time today. I think what I'll do first, Guy, is I'll bring up some slides that I used at that presentation that you mentioned earlier. So I do that real quick right now. So when we think about, what's going to happen over the next year, what's really crazy is there's a bunch of things going on. And Guy, you talked on it, you touched on it in your thoughts. Is right now the biggest thing kind of in everybody's head is inflation, and we're really thinking about what's driving that as we look both what has happened and what's going to happen. So we'll kind of talk about the three things we think are driving that. First, we look at labor, and labor's a big issue for the economy right now. As anybody who's had to try to hire anyone or has been dealing with any of the wage costs that go along with it, continues to be a struggle. Unemployment is at record low, and I'll kind of talk about what that means and what's driving that. But obviously, there's a huge labor shortage across almost every industry. And the cost of that labor continues to increase at a level we haven't seen in quite some time. We continue to see supply chain issues across almost every industry, whether you're trying to buy a car or lately seems like trying to buy cream cheese. You can't find either without a lot of work and a lot of effort. And we all know that's all just driven by what's happened in our supply chain, from getting goods overseas to just getting them through our ports to even just getting onto the shelves. Third, we have a lot of pent up demand and people have been saving money. Nobody, for a long time, there weren't very many trips that were being taken. We had government stimulus that was out there. These were things that were, increasing, household net value or net worth. And again, these three things combined. So you have increased cost of labor, harder to find goods, and people with more disposable income. And when you put those three together, you wind up with inflation. And we've seen that in spades over the past few months. The most recent data that came out on at the end of last week showed inflation was, I think, north of 7%, which is just an incredible number when you think about where we've been over even the past 20 to 25 years. How companies deal with this over the coming year, these three things and inflation will be, key to their success as they look forward. We do expect, some of our economic forecasts show inflation probably, starting to temper or to wane over the next few months as we get kind of back to a little bit more normalcy, but we'll have to keep an eye on that. As we look ahead, we talk about the labor market, overall employment is still down a couple percentage points over what it was a couple years ago. That's crazy. There still is, even though there's still 3 million less jobs, there's a lot less people looking for those jobs. One of the things that's amazing to see is even when you look at the number of open jobs relative to the number of unemployed, the fact that there's over, around a job and a half for everybody who's looking for work, that's something we haven't seen, pretty much in most of our record, some of the records we have going back. If you want a job, there's typically one to be found. It's kind of matching up, where the jobs are, the skill set, and then the people. So even though employment hasn't necessarily recovered, there still is plenty of job opportunities. And when we think about why, the overall labor participation rate hasn't recovered, we kind of think of it in two ways. One is by age and then by education. By age, for the most part, those in the, kind of, working class age, kind of pre-retirement age, they've pretty much recovered. They're, near 99%. For those that haven't, that's typically something where they've figured out a different way to structure their financial life, to not necessarily have to go back to work, whether that's a single parent working or only working part-time, things of that nature. Where we've seen a huge loss in labor force participation is those that were kind of in the, kind of the age 55 and over, those heading into retirement. There's really a couple of reasons driving that. The stock market, it went up, although it initially blipped, obviously, right after the pandemic started. It's come back fairly strong, leaving them in fairly strong financial health. The other side of it is that unfortunately this group tends to be predisposed to issues with what's happened during the pandemic, whether they were immunocompromised from a health standpoint or just didn't want to take the risk of being in a mixed environment. They've decided to stay away at this point. Whether they come back, I'm not sure. It'll take some time to determine whether that actually happens. The other side of this is where they are in their education. Those that are college educated or higher tend to do pretty well. They obviously weren't quite as impacted as those who weren't, and they've tended to stay in the workforce. Where we've seen the biggest issue again is in those that are only high school educated. Those obviously tend to be at the lower end of the obviously skewed lower in terms of pay, and we've seen those are the hardest group to come back. They were obviously they got a decent benefit from unemployment insurance. You could, I think in New York, between the two unemployment insurances, the federal and then the state value, I think it was somewhere near a $50,000 a year job equivalent for those roles. As that's gone away, some of those benefits have gone away. We've seen some increase in participation, but again, these people want to get paid for what they want. Paying minimum wage isn't necessarily going to work as we move forward. They're definitely commanding a higher wage, and we see that work its way through the entire wage bracket. As I said, wages are going up. This looks at a 2-year annualized growth. So you kind of take that 3.7%. What it's saying is 2 years ago, wages are 7% higher now than they were 2 years ago. And they've been going up for, other than that little break around the pandemic, they've been going up rather precipitously. So again, it's not just there's less people, and there's a definite a need for those, a definite need to increase the pay of those people. I'll take my own personal experience. We all probably have had experiences in hiring people over the last 6 to 9 months. Anybody who's in that 8 to 12 year out of school kind of look, they are probably what I think is in some of the most demand in terms of the professional side. We're seeing a lot of people, recruited in that area. And there's a changing dynamic, obviously, here. you don't need to live where you work. That's a new thing that really has taken hold. You can live in Buffalo, you can live in Ithaca, and you can work for a company in Atlanta, Chicago, pick a big city. You get the benefits of a smaller town, and you get, the idea of working for what is like probably a national company. You go to the corporate headquarters maybe 2 or 3 times a year, and it works out for you. It works out for everybody involved. So again, the dynamics, especially, we think about a region like Syracuse or just upstate New York, they're the ones who are going to feel this kind of outsourcing of jobs to people taking jobs in other areas, not necessarily the people leaving. So there's a benefit and a kind of, there's 2 sides of this coin. The benefit is they're bringing the wages back to the region they're living in. The downside is the local companies are making it more difficult to find those people. So again, we just see that, as we've moved along. All of these trends, they're not unique to, they're dissimilar to what we see in, central New York or upstate New York in general. We see all these same issues. And really, like I've said, the key for companies, as we think about what companies have to do, the key for companies as they move forward is how do they manage all of these different issues? How do they manage their employees and their supply chains? And how are they going to evolve or adapt over time? You're not going to, the idea, like I said in the center state conversation, you're not going to just be able to say to people, well, the job is Monday to Friday, 8 to 5, we'll see you. If you have that, obviously for certain industries, that's probably more of a requirement. But for the industries where it's not, it's going to be you're going to have to evolve with, and be agile with what the changing dynamics are, especially with those that necessarily were, barely, had just come into the workforce around the pandemic or haven't even lived through the pandemic. They're going to expect flexibility in the number of days they're at work and their work location. They've learned how to work at home. They've learned how to work out of town, and they love and like that flexibility. So I'll pause there, turn it back to you, Guy, and then we'll continue from there.
Thank you, Peter. We'll now turn to Tamer, who's going to talk to us a little bit about what the market forecast looks like. As many of you know, Tompkins Trust is a sponsor of the Wednesday Morning Roundtable, so we were delighted to be able to get someone from Tompkins Financial Advisors to join us this morning to talk to everyone. Mr. Elshourbagy is the Vice President and Senior Portfolio Manager for Tompkins Financial. He's responsible for $4 billion across the firm's investment strategy. Some of that is the Community College's foundation. We hope he does even better this coming year. He's had a good couple of months as a member of the investment committee. He brings more than 23 years of investment experience to portfolio management and fundamental investment research. He has spent a decade. He spent a decade with Brandywine Global Investment Management in Philadelphia as an equity analyst for the firm's large cap strategies, and had assets of about $7 billion there. And prior to joining Tompkins in 2017. He was a portfolio manager and head of research at John Ullman Associates in Corning, New York, with oversight of about $1 billion there. He's outside of work, he is on the board of the Women's Opportunity Center, as well as Tompkins County Youth Services in Ithaca, New York. Mr. Elshourbagy, welcome to the Wednesday Morning Roundtable.
Thank you, Guy. I really appreciate it. This is a wonderful forum, and I think the presentation and discussion is very timely, just given all the volatility that we've seen, not just in the equity markets, but also within the fixed income space, which we'll get into in just a second. So generally speaking, to kind of, frame out in terms of the discussion itself, and I'm going to get this set up just a second. In terms of just framing out the discussion itself, ultimately, let's look at where we've been, kind of where we're at today, and ultimately where we're likely to go. And so with regards to the markets themselves, you look over the past roughly 26 years, and we've been in a pretty good position when you look at the equity markets. There have been times of meaningful volatility, which is without question. When you look at, for instance, the tech bubble back in '99, you look at what we saw during the great financial crisis and market drawdowns there. And even more recently, when you look at the height of the pandemic back in 2020, where you saw equity markets fall by about 34%. So really, when you look historically, the times that we've seen excess levels of volatility and uncertainty, that over time, those moments in time have been met with certainty, but certainty at a higher level. And so as long-term investors, one of the things that we do want to stress is, really staying the course, but ultimately the times that you're most uncomfortable to invest is usually the best time to be putting money to work. Now, as you look at the markets year to date, really you look across the US, you look across Europe, you look across Asia, we're seeing notable declines. Within the US, you're seeing the S&P now down about a little over 7%. NASDAQ, which is a very tech-heavy index, is down almost 12%. And Russell 2000, which is a broad measure of small cap stocks, is down about 9.6%. Over in Europe, a little bit of a mixed bag, but you are seeing some outperformance in areas such as Germany, such as the UK. You look at France, they're all outperforming, generating for the most part negative performance year to date. We are seeing some relative outperformance there. And over in Asia, you are seeing a little bit of a mixed bag, but generally, when you look at Japan, when you look at China, we are seeing some declines within those indices, again, overseas. Now, what's interesting is when you look at fixed income traditionally has been that steady eddy where you're really not making that much money, but you're generating some performance. It tends to be an anchor. And when you look at performance year to date, it's a continuation of what we've seen last year. So last year, when you look at the US Barclays Aggregate Bond Index, that index, which is a broad measure of fixed income securities in the US, that index was down about 1.7, 1.8%. You're seeing losses accelerate year to date, now down to about 3.5%. You're really not insulated when you look from a quality perspective. Even in high quality issues, you're still seeing negative performance within areas such as AAA rated issues. And even as you start to get down lower within the credit quality spectrum, accelerated losses are very much evident. You look from a duration standpoint of maturity, the longer you are, you're seeing those losses even that much worse. And generally, whether you're invested in treasuries, corporates, or securitized debt, you're still seeing losses. Ultimately, the basis behind why you're seeing declines in fixed income is going to be a function of where we're seeing interest rates today. They've continued to climb higher. Again, with a lot of the points that Peter mentioned with inflation, that's pushed up rates higher, again, resulting in some of the losses that we've seen there. Now, when you look at the US, generally, the economy is doing quite well. We're likely to see close to about a 6% GDP number growth when you look at 2021. And when you look at just manufacturing and services activity here in the US as measured by the PMI, which is Purchasing Managers Index, anything over 50 shows expansion, anything below 50 shows contraction. So as you can see with manufacturing, the economy is still expanding, it's still growing. From a services standpoint, it's growing a little bit faster, just as the economy has started to really reopen. We're seeing good demand, and ultimately, services continue to do quite well. Now, one of the biggest problems that we're seeing as of late, and really when I say as of late, it's over the last, call it 6 to 12 months, where inventory levels just aren't keeping up with demand. And so this is a measure of looking at inventory levels to sales. And as you can see, they continue to decline since the height of the pandemic. To kind of put some numbers together with this graph, you saw sales that grew year over year towards the end of last year over year, up 17%, whereas inventory levels only grew about 8%. We ultimately weren't able to fulfill the demand that we're seeing within the economy overall. That's translated into congestion at the ports, congestion along the rails, along trucking, really any mode of transportation, you're seeing a lot in the way of congestion. So this is what they call a terminal congestion index to kind of give you a sense. When you look at the blue line here, this is North American congestion. As you can see, it continues to trend higher. We've seen a little bit of a decline here, but when you look over in Europe, it continues to accelerate. As those economies are really reopening, it's weighed on congestion and ultimately has pushed through higher prices. Again, as Peter mentioned, it's no surprise. We got about a 7.5% headline number on inflation on CPI, which is generally higher than where we've been historically. It's higher as compared to where the Fed has been targeting. And really, those are the factors that we're seeing on the basis of low inventory and constrained supply chains. The biggest, I would say, factor in terms of pushing up price is going to be energy. You look at oil for most of 2021, we were anywhere from that $50 to maybe $60 range in terms of oil. Today, we just saw it cross $95 a barrel. And so you're seeing prices with oil, prices at the pump continue to move higher, and that's weighed on the economy overall. Now, with all that said, you've seen the economy, or rather the Fed, I should say, make an abrupt change in terms of their stance on inflation and their stance as it pertains to future rate hikes. So it wasn't only several months back where you had the Fed telling investors, look, we are not going to raise rates until through 2023. This is a chart that's projecting how many rate hikes the Fed is expected to do over the next 12 months. And so you look at this graphic here, and ultimately it tells you that over the course of the next 12 months, we're expected to see about 6 rate hikes. This is currently what's being priced into the market. Again, a complete shift from where they were several months back. And again, a lot of it's due to the inflation that we're seeing in the economy. We talked about unemployment. Unemployment continues to decline from the levels that we saw back in April 2020, now down around 4%. Wages, as Peter mentioned, continues to grow, which is a good thing when you look at negating and dampening some of the pricing pressures that we're seeing across the board. Now, there are factors to kind of consider outside of wages moving up that ultimately is a net positive when you look at the prospects of the economy on a go-forward basis. We're all doing much better from a net worth perspective. This is looking at household net worth, and you look even as compared to prior to the Great Financial Crisis. When you look at net worth, we're over double where we were as compared to that time period. You've seen clearly an appreciation of stocks, so 401ks have gone up nicely, and of course, housing has also done quite well. So generally speaking, Americans are in really good shape. We have a lot of wealth, we have a lot of savings, again, as Peter mentioned, which is very much net positive. When you look at delinquencies on everything from credit cards to student loans to mortgages, auto loans, home equity revolving debt, delinquencies continue to decline. We did a lot in the way of not only adding to our savings during the pandemic, but we've also paid down credit card debt and other debts within our respective personal balance sheets. And that's all a net positive when you look at the economy, considering the fact that our spending accounts for about 2/3 of GDP here in the US. COVID case counts. This is looking at COVID case counts worldwide. They continue to decline, and we're seeing a much more dramatic decline in new case counts here in the US. When you look at corporations, particularly when you look at S&P 500 companies, companies are reporting very, very strong earnings. For 2021, we're expecting to see earnings growth year over year of about 45 to 50%. So an incredible jump when you look at profitability for companies. And you might say, all right, well, 2020 was probably a horrendous year. Well, it wasn't all that great, but the number was down about 10%. So if you start to spread out and look over a 2-year, call it stack period, you're looking at earnings growth that's well in excess of what we've seen historically. Now, one of the things that I spend a lot of time doing as an investor 4 times a year, and this spans over the course of several weeks, is listen to the conference calls and review the transcripts of what CEOs and CFOs are saying within their respective businesses. This really gives you a good perspective and good lens in terms of ultimately where we're going, some of the competitive pressures that CEOs are seeing, some of the factors that potentially can allow us to kind of put together our outlook on the economy and where things are likely to go. And generally speaking, as you can see, costs are moving up. We all know this. Tyson reported an unusually high number when you look at their cost of goods sold, and what happened there, that number was up almost 18%. That resulted in them pushing through pricing of almost 20%. What was interesting within that respective business is that they didn't see volumes fall off a cliff. Volumes actually continued to expand. Now, granted, they were up about 1%, but generally that demand still stuck. A lot of CEOs, whether it's Union Pacific, Dow, they're pointing to the idea that they expect to see in the back half of 2022, supply chains getting better, inventory levels getting better. Bank of America, Brian Moynihan, very well-respected CEO, talks about how ultimately you look at spending during the holiday season, and that was up 26% over pre-pandemic levels. Disney, we all know their products. We all know their parks. They are expensive, as you know what. They reported a 40% growth when you look at per capita spending as compared to 2019. The consumer, again, is very much flush with cash and is spending and continues to be ready to spend as the economy reopens. You're not seeing demand slow down at all, whether it's Whirlpool or even Waste Management, one of the largest, or the largest, I should say, waste disposal company in the country, where typically their customers that are very much price sensitive have been renewing contracts at much higher rates and been okay with it. And so generally, as you listen to what companies are saying today, fundamentals remain strong, and ultimately demand is not slowing down, even though they are taking up price. Now, a couple of slides I think worth mentioning. One of the things that we hear from investors a lot of time is, look, rising interest rates are typically bad for stocks. You definitely want to be out of stocks as rates rise. And we would argue the exact opposite. Ultimately, when you look historically at, for instance, periods over the last 15 years in looking at the 10-year treasury yield, so where the yield really jumped up during these time periods, we've seen stocks up double digits, and more specific to tech stocks, that they've outperformed in 4 out of these 5 time periods. Now you might say to yourself, all right, well, what about with the Federal Reserve? They're going to be probably, aggressive and starting to raise rates as soon as next month. Historically, this is research coming from LPL, or a chart from LPL, that ultimately looked at what the stock market did over the next 3, 6, and 12 months. On average, we've seen stocks up 10% following the first rate hike. That was positive 85% of the time. You might say to yourself, all right, well, what about war? We've got conflict with Ukraine and Russia. We have issues with China and Taiwan. What does that mean for stocks? And so this is research going back and looking at prior time periods where ultimately, from start to finish during the duration of war, that stocks have been positive. Now, granted, prior to war, ultimately stocks have sold off. You've seen a drawdown on average of about 5 to maybe 10%, but generally throughout the duration, and this is even looking more recently at the Gulf War, where we did see stock prices continue to grow. And this was evident primarily in large cap stocks, but really across most asset classes, with the exception of small cap stocks and specific to the Gulf War. Now, as we put together, again, sort of our outlook, the economy continues to be poised for continued growth. Now, granted, we're not going to see a 6% headline number on GDP here in the US, but ultimately, as supply chains begin to improve, as we start to get inventory coming back on shelves, that in our minds is a net positive. We're also looking at the labor market, which continues to be extremely resilient. One of the things, as Peter mentioned, that we're hearing from companies is the inability to hire not just good talent, but really any talent. And so we think that the labor market will continue to be strong, which gives consumer confidence, a boost on that front. We think, again, the consumer remains in great shape. Ultimately, with regards to inflation, we think that that will begin to moderate towards the back half of this year. And longer term, we think inflation is going to remain fairly low. You do have technology and really companies and consumers embracing technology that tends to be deflationary in nature. And lastly, we think earnings will continue to be strong, not to the tune of about 45% as compared to what we saw in 2021, but we should have, I think, earnings that may surprise investors on the upside. Now, with that, I'm going to pass it back to Guy for any questions.
So thank you, Tamer. A couple of, I don't want to bounce all over the place with both of you, but there are a couple of trends that you mentioned besides the unavailability of cream cheese for dips for Super Bowl parties yesterday, as we tape this on Monday. But there are some items that are out there that I just wanted to ask both of you to, or one or the other to chime in. So obviously, the big issue for many has been this issue of inflation. You mentioned the 7% report on Thursday of last week. But when you do have unemployment at 4%, and it is tough to hire employees, whether it's at a high end or going through the drive-through, and you have about 500,000 jobs added to each of the last several months, what can the Fed do to deal with just inflation, but not at the same time drive up unemployment, which would seem to be a concern as we're rebounding from the pandemic? And that's
I can go first. Yeah, I'll take that to start. I mean, I think just what it's starting to do. Obviously, it's changed its tenor over the past 6 months from, we'd be very slow and measured in rate hikes to signaling, and then the market was, to what Tamer pointed out, just an enormous, 5, 6 potential rate hikes over the next year. That's similar to what we're seeing as well. I think I don't know that I think it'll help curb inflation to some degree. I think inflation, even if the Fed were to do minimal, I think would still come down over the back half of the year. I think they're doing what they can to slow it down, but I think it would slow itself down. At the same time, that doesn't mean that prices are going to go down. It just means they're not going to go up quite as quickly. So don't think that the prices we're seeing now are going to change, dramatically. An easy example for me is I have a family member who owns a restaurant, and she just raised prices again, another $1 or $2 on every item because her costs are going up as well, and that's just not going to change. Tamer, I don't know if you want to your thoughts on that.
Yeah, no, I would definitely agree. I mean, I think the worst thing that the Fed can do is be extremely aggressive with rate hikes, because clearly I think that's going to put a chokehold on the economy. I think that the best thing they can do is ultimately, maybe do 1 or 2 rate hikes and then just sort of take a wait and see type approach and see if things, slow down, see in terms of what happens with prices if they do begin to improve and not grow as much as we've seen as of late. But again, the biggest challenges that we're seeing are, again, supply chains and, again, inventory levels. And I think that should start to improve. And that's ultimately what we're hearing from businesses. So again, it's really going to be the Fed, not being too aggressive, just sort of being, more measured in terms of their approach.
And before getting back over to supply chain for a second, just have the markets taken into effect that the Fed is going to do these raises? And more importantly, why the wait by the Fed?
Yeah, I think they were caught flat-footed is the biggest thing. I mean, they didn't anticipate that inflation would be as strong and long-lasting as it has been thus far. You also look at different factors, whether it's oil, where, again, inventory levels remain low and there's not much in the way of supply coming online that's naturally pushing prices up. And so, I think ultimately they were caught flat-footed, whereas they should have been a little bit, quicker with that decision making. And I think that, the other point also to mention is the markets have anticipated, which is why you're seeing stocks down this year. there is that concern that they're going to make potentially a policy mistake, which ultimately is concerning to investors. And so, that has ultimately weighed on prices, not just here, but again, on a global basis.
And besides the supply chain issues that we hear about at the grocery stores, and more importantly, whether it's a cargo ship getting stuck in the middle of a heavy traveled area, do you see these supply chain issues resolving themselves sooner than later? And how much impact do they have, if I can make this more complex, on inflation?
Tamer, I'll hop in first here. I mean, I think it's going to take a while because it's not necessarily the raw product that's the problem with some of these supply chain issues. It's a component. So it's not, the way we think about it is it's not the cream cheese, it's the container that it comes in. So there's plenty of cream cheese out there. I'm not sure this is the case, but I'm saying there's plenty of cream cheese out there. It's the container it comes in that's the problem. The car example is an easy one. There's plenty of cars out there. There's a chip it needs. The issue is typically a chip issue, and those are the problems. Again, you're buying cars now, one on spec and two with known defects, with a known recall. It says, hey, when we get this chip in, we'll call you back, and then whatever that chip covered will start working again. So I don't necessarily think that there's a quick solution to a lot of these issues. It's going to take time to work itself out. Or Tamer, your thoughts?
Yeah, I would say it's going to take time. Again, I'm sort of leaning more towards that back half of the year type timeline where I do think, things will improve. I mean, we are, trying our best to try to get, more capacity on the rail lines, more in the way of alleviating some of the constraints at the ports. And so, I think these things, again, will resolve themselves. I think, again, it's a back half type timeline. But generally, if it does extend longer, to your question, it probably will result in pricing moving up, at least for the foreseeable future.
And so you mentioned Ukraine, we'll talk about China in a second. I do want to go and also talk about the job market, but going back for a second, if as we're taping this on Monday afternoon, there's more news about artillery pieces being brought up to the border, et cetera. And one of the key factors on an economic point of view are rare gases that Ukraine produces or has in availability that run the economy of the West. So what is your outlook for the foreign outlook in the sense of impacts on the economy, whether it's Ukraine? And I know everybody has goodwill right now with China because we're in the second week of the Olympics, but that all wears off in about 2. What do you see as both Russia and China as impacts on the economy, at least in the West?
Yeah, I mean, I think those are major concerns. These are major factors to consider, as an investor. I think that the outcome will likely not be good if there is conflict. I do believe that level heads and cooler heads will prevail, and that ultimately we'll get past this without any type of major undue harm. But again, the sort of the scenario behind whether it's commodity prices, stock prices, what have you, if there is in fact conflict, is not going to look good in the near term. You will see meaningful drawdowns in the market. You'll see prices moving higher. But generally, as a long-term investor, I would very much, I'd hate saying it, but very much welcome those opportunities, because you're really buying stocks on sale at that point, again, with that long-term time horizon. I don't know, Peter, if you had.
No, I think you summed it up well. I don't have anything to add there.
So I'd like to go about the job market, because obviously that's impactful for our members. So there seems to be 2 or 3 things impacting all at once. One's this great resignation that we keep hearing about. We're all changing the way we work. I do not know, Mr. Kneis or I would be doing, I'm assuming that is your home behind you, because I saw somebody walking behind you that looked shorter than most adult employees. And so 2 years ago, we would not be doing this. So how is the great resignation, this issue of remote working, not being able to fill positions, how's it changed the markets? How's it changing the economy?
It's changing the economy because it's forcing, it's forcing you to break old habits, which tend to die hard. How you work, how you live, how you work in this new economy as we all kind of get back to the office. M&T just announced its return to office plans last week. How we get back to the office is changing, and it impacts the economy, as I mentioned. That transferability of people to live in one place and work in another, forces people to rethink how important is it that A, you're in the office, or B, that job is sourced locally. And also just what does that mean from, and I don't even know that maybe Tamer has, but what does that mean in terms of, like, I don't know, it's wealth or income redistribution around the country? As maybe it'll be not enough to make a difference, but as we start to see people live in one place and work in another, they're bringing obviously their income to a different spot from where they work, and will that matter? We'll have to kind of see how that works. But as I kind of mentioned in my notes, as a business leader, you have to be agile in how you think about those things, and it's not something that's done easily. Even at the bank, we've had plenty of discussions about what will return to the office look like going forward. How necessary is it to be in, whether it's 1 day, 3 day, or 5 days a week?
Yeah, the only thing I'll add to that, I think with technology, exactly how we're doing this presentation discussion, you'll have a broader, more broader access to talent, and talent, nationally for that matter. And so, I think that's a net positive. And I would even argue that you probably see more in the way of productivity. I think to myself, during COVID, while I was at home, that ultimately I was working more. Granted, I had more flexibility, with my hours, but I was finding myself working more and getting actually more done. There's less in the way of dealing with traffic and commutes, and the only distraction is maybe my 1.5-year-old and French bulldog barking in my ear. But otherwise, there is a lot in the way of productivity, I think that can be had with how things are being set up today, and likely on a go-forward basis.
Can I ask a couple of questions about just small things that might impact the economy that we just don't know about yet, but maybe you have all been looking at? So 2 were heavily advertised over the last 2 days, and I think if I see one more sports betting ad, whether it's Caesars or whoever, not underwrite, we're now going from an economy that had a lot of betting, it looks like, underground, especially in New York and New Jersey, to being much more of a factor. And we saw some numbers from New York of the growth. How does that impact the economy? Either the below the economy or above the economy, what we report?
It's going to take a while. What it does change is how easy it is, right? I mean, it's going to, it's gone from, to your point, an underground or a destination thing, right? You had to be at a place to, here's my phone, 5 clips, 5 taps of the screen, and I've just, put $100 parlay down on a game. So the ease of it is there. Whether enough people actually buy into it to have an impact, I mean, I know the numbers are gaudy, but then when you start to think of, the impact, how big an economy is, they tend to, big numbers over big numbers don't necessarily make a huge impact. But I don't know, Tamer, your thoughts?
Yeah, I mean, I think incredibly well said. I mean, definitely the ease factor, I think, is what's concerning. And then I sort of relate that to what we're seeing with those meme stocks, the GameStops of the world, the AMCs, and how a lot of people are making massive bets on these companies that, have bad balance sheets, don't generate a lot in the way of free cash flow, and are just fixated on this idea that, they can strike gold with these underlying investments. And, we've been seeing over this most recent downturn in the market that these guys are losing their shirts. They've been making these huge investments and just completely, losing just a ton of money. And so, I think that ease is the biggest concern that I have. I mean, will it really make a dent in terms of the economy? Probably not, but you will hear stories of friends or others that, definitely have lost quite a bit of money, even similar to what you saw back in 2000 at the tech bubble.
So the other one that's a weird one for me is this issue of the cryptocurrency. And so last night there was an ad that you could put your QR code up to, and I was stupid enough to do that last night, just to see who was selling what, and it was a crypto. But to me, crypto currency is different on this economy for two reasons. One, it's a means of investing for some, and I know, Tamer, you and I were in a meeting maybe 4 months ago. There were some ads the night before, and people were asking, is that a good investment? But it's also a currency issue now. And, we have some on the West Coast of the United States, there are some governments that are looking to take crypto as payment. How does crypto impact an economy that, and really a world economy that's based on the US dollar?
I don't know, Peter, if you wanted to.
Nobody wants to take this one.
This is to me, I don't really have much to say other than this. This is going to be this is the internet of 35 years ago, or this is smartphones of 15 years ago. How this evolves over the next couple of years, right? I mean, the volatility is a big thing. I mean, and the potential lack of knowledge, right? Someone just thinks they understand Bitcoin, but they really don't. And so how that kind of comes about over the next few years is going to be huge. I mean, if you look at just Bitcoin, which is just probably the most most infamous or popular of them, there's obviously many others. It's not uncommon to see swings of very large amounts in very short periods of time. And if you're not well educated, all the comments that Tamer just said about what impact mobile betting could have, magnify those, and that's what you could have with Bitcoin. And I'm not saying that people can't do it well and become fairly wealthy doing it or manage it, and it can't become an important part of the economy. But it is I think is at this point is still something that you have to be very well educated to understand if you want to do it successfully. And I'm not sure that everybody's done that, but I'll pause there.
Yeah, no, I mean, 100%. I mean, I think the biggest thing is it's not a store of value. I can't tell you the number of times people have said this is a great store of value, similar to gold. I definitely don't agree with that. The thing, at least when I look at Bitcoin, ultimately, it doesn't pay me dividends. It doesn't generate cash. I have no idea, from a balance sheet perspective. I mean, there's nothing tangible to really point to. And so even from an investment standpoint, if you want to have an investment in it, that's fine, but I would keep it at, rather in that bucket of, I'm okay to lose a bunch of money if it doesn't work out. In terms of, does it really affect, or, what are the implications on the broader economy? Today, I just don't think it's a factor. I think you're able now to obviously have, more convenience with being able to use it as a payment method. But ultimately, you could simply make, cashless payments, whether you're talking about Venmo or PayPal or, Cash App or what have you, that I think you can ultimately make, payments using, those avenues, similar to that of Bitcoin, but, I think a lot more convenience can be had with that.
And I'm not advertising this, but I think it's on PayPal. You can buy into these currencies now on those sites. So the availability is out there.
You could buy, and it's not cheap. I mean, there is a cost to buying, through Venmo, crypto. I mean, it's going to be a few dollars, but when you look at from a percentage basis, I mean, it's probably anywhere from 1 to, I don't know, 4% in terms of what you're being charged to make that purchase.
And do you see this as being an area where you will see a lot more regulation as time goes by? Or are we in the Wild West where we're staying right now?
I think over time you'll have to. If it becomes even that much larger in size, at some point you're really going to see meaningful regulation.
So I want to turn, go ahead, if you have something else to add, Peter.
No, I didn't. Just was going to agree with what Tamer said.
So two final items I want to ask you about, and this is more for Tamer on this first one, is this issue of environmental, social, and corporate governance, which we're hearing a lot about, this ESG investing, where we're going to invest in priorities that we might have socially. We saw some move on this with Exxon in the last quarter, and then some rebuttal from critics to ExxonMobil right after that. How is that going to, is ESG, this environmental, social, and corporate governance issue, going to impact the markets, or is it just so small in the bigger picture right now?
No, it's definitely been growing. I mean, you're seeing more and more dollars moving into vehicles that have ESG values as part of their investment approach. I mean, I think I've seen year-over-year growth of anywhere from 15 to 17%. And so it's here to stay. It's really going to continue to grow. I think, you look at companies, for instance, and I've looked at studies in the past that look at companies that have really adopted ESG and really have, for instance, diverse boards or have gender equality when you look at their labor force. And ultimately studies have shown, I think this actually was coming out of Bank of America, that showed that companies typically have a higher ROE, or return on equity, by way of employing high values as it relates to ESG. I think though that even while the approach, has been around for decades now, there's still a lot of ambiguity with regards to how do you score and how do you rank companies. So I've seen in the past where certain, companies that rank ESG factors for corporations vary wildly between one company versus the next, and looking at that same business. And so, I think there's still a lot in terms of development there, but a lot more companies today are really adopting ESG. And even with regards to their disclosures, you look at, for instance, Apple's website or even JP Morgan's website, they've got, whole slew of information with regards to what they're doing on an ESG front. So again, I think it's here to stay, and it's going to continue to get quite large over time.
Go ahead, chime in, please.
Yeah, I actually didn't have anything really to add there. I mean, I think Tamer said it well in terms of, it's how important it can be. I mean, obviously M&T has set up our own ESG group with the person leading at one of the highest levels in the bank. And obviously we have, as many companies have done, is added a chief diversity officer as well. That's obviously been something that's become more prominent over the last 5 to 10 years. And so I think those things are going to be important, as people think about companies, whether it's just joining a company, I think from an employee standpoint, or, maybe as Tamer thinks of more from investing, companies, people want to be at companies that they feel, are responsible.
So one of the largest pension funds in the United States happens to be in the state of New York. And I know that the comptroller of New York is getting who manages that fund, gets a lot of pressure on that. Will this issue towards whether it's environmental, getting out of oil stocks or whatnot, will that really come from big pension managers, or is it going to come from individual investors, or is it not going to come at all?
I think you're gonna continue to hear from, whether it's pension funds or just, large investment companies, let's say a BlackRock, for instance, that ultimately will continue to exude pressure on businesses to, not just, adopt ESG values, but also disclose. That's the biggest thing in terms of, what we're seeing is really disclosure. And I think one of the biggest concerns that you're hearing is, that fear of greenwashing, where, companies ultimately aren't being, 100% forthcoming with, what they're doing on an ESG front. But again, I think, it's really going to be from both large institutions and individual investors showing interest and really investing in, these type of investment vehicles that, look for high, ranked ESG companies.
So last question really comes out as to what you see as the outlook. Obviously, the president has gotten he's got his infrastructure bill through, but you've got this Build Back Better bill that is stalled. And I know originally many investment advisors were factoring that into their outlooks. Is there going to be a reverse impact if they don't pass this bill when it comes to construction or infrastructure items that may have been part of that? I know higher ed was a piece of that when it came to community colleges, and obviously Jill Biden, the First Lady, has said that's not part of it. But there are other issues in daycare that people were hoping for. If they don't pass something like that, is there a reverse impact on the economy?
I don't think that it's, I think first of all, from a sentiment standpoint with regards to the market, I think you're probably going to see investors be disappointed. Will it completely reverse from an economic perspective? I don't think that the impact, is going to be as dire as one would think. I think you do have, again, a lot of positive factors and catalysts that I think will continue with helping grow GDP. Again, the consumer is in great shape. Many of us ultimately obviously with young ones haven't been able to go out and dine at restaurants or take vacations or, do all sorts of traveling. And I think that's going to be the next leg with regards to really getting the economy in a much better position on a go forward basis. But again, maybe Peter might think otherwise, but I don't know if necessarily, if it doesn't go through that, it will be a detriment to the economy.
Yeah, I mean, I think it's a speed bump on the way. I agree with most of what Tamer said. I think the economy is poised to just continue to grow at a pretty profound pace, especially with what he describes. And I would agree with on what the consumer is going to do, as considering it drives so much the economy. And so I think it's not, it could help. How much it's going to hurt, I mean, always, maybe it's a small, like I said, speed bump in the stock market, but I think from an economic output, it's not a huge impact.
Well, gentlemen, we want to thank you for your time. We've had Peter Kneis of M&T Bank giving us his perspective on what the macro outlook is on the economy, as well as Tamer Elshourbagy, who is from Tompkins Financial Advisors, to talk to us about the markets and what's out there. So, gentlemen, thank you for joining us for the Wednesday morning roundtable. We will be back next month, as we said, with a discussion on healthcare. The second and a third series on the impact of COVID and also the economy. We'll finish off in April with a discussion on workforce development and how that's impacting the world around us. And then our last program for 21-22 is the veteran services, and we'll talk about those impacts as well locally that we have a program set for. We do want to thank our sponsors again, Tompkins Bank, who has been a longstanding supporter of the Wednesday morning roundtable, as well as the Allen Family Foundation and the Fred L. Emerson Foundation. I'm Guy Cosentino for Cayuga Community College and the Wednesday morning roundtable. I want to thank you for joining us. We hope to be returning in person sooner than later, but otherwise enjoy the rest of your day. Thank you.